Financial Institutions Management, Chapter 4-8, presentation by Rodriguez Williams. Securities, brokerage, and investments banking. Broker-dealers and titles primarily engage in acting as agents between buyers and sellers in buying or selling securities on a commission or transaction fee basis. Document brokers, stockbrokers that conduct trades for customers but do not offer investment advice. Commercial bank, a financial institution that is owned by stockholders, operates for a profit, and engages in various leading activities. Investment banks. Investment banks perform a variety of crucial functions in financial markets. Underwrite the entitled sale of stocks and bonds. They deal with merger and mergers, acquisitions and spin-offs, middlemen in the purchase and sale of companies, private broker to the very wealthy. Investment bank. Investment banks were intentionally created in the U.S. by the passage of the Glass-Steagall Act. Prior to this, investment banking activities were part of large money center commercial banks. The lines between investment banks and commercial banks begins and blur as legal separation between investment banks and commercial banks is no longer required. Underwriting stocks and bonds. The process of underwriting a stock or a bond issue requires that the investment banker purchase the entire offering at a predetermined price and then resell the offering in the market. The services provided during this process include giving advice, filing documents, and also underwriting best efforts or private placement. Mutual funds, an investment company that issues portfolio shares to investors. Money from shareholders invest in a wide range of stock, bonds, or money market securities. Each investor shares proprietary in portfolio income and investment gains and losses, as well as the brokerage expense and management fees. Open-end fund, number of shares issued solely depends on investor demand. Okay, here's an overview of mutual funds. Objective, rates of return and risk characteristics vary. Examples are capital appreciation funds, world equity, corporate bond, high yield bond, world bond, and also government bond. Here's an example of net asset value. NAV per share value of a mutual fund investment holding. Okay, NAV equals market value of assets and portfolio liabilities over number of shares outstanding. And here's an example below. A mutual fund has $100 mile in assets and $3 mile in short-term liabilities. 10.765 mil shares outstanding. What is the NAV? And here's the solution below. 100 mil minus 3 in parentheses / 10.765 now equals 9.0107 per share. Here we have hedge funds, a special type of mutual fund that received considerable attention following the collapse of long-term capital management, different from typical mutual funds as follows. High minimum investment averaging around 1 million. Long-term commitment of funds is required. High fees, typical 1% of assets plus 20% of profit. Okay, here we have managing credit risk. A major part of the business of financial institutions is making loans, and the major risk with loans is that borrower will not repay. Credit risk is the risk that a borrower will not repay a loan according to the terms of the loan, either defaulting or making late payments of interest or principal. Okay. Risk of financial institutions. In today's economy, running a financial institution is harder than ever. Leaders are faced with critical challenges in finding new and better ways to increase top line revenues, maintain necessary capital ratios, improve margins, strengthen balance sheets, and enhance effectiveness regulatory challenges, compliance, economic volatility, and issues involving data security. Distress, lending, and troubled assets add even more concern. Alright, here we have risk of financial institutions continues. In risk of financial institutions, we have interest rate risk, the risk incurred by an FI when the maturities of the assets and liabilities are mismatched. Technology risk, the risk incurred by an FI when its technological investments do not produce anticipated because of restrictions, intervention, or interference from foreign governments. Operational risk is the risk that existing technology, auditing, monitoring, and other support systems may malfunction or breakdown.